Well, good afternoon, members and guests, and welcome to Brighter Super's Fund and Investment Update webinar. It is just fantastic that you could take some time out of your day to hear about what's been happening with your super fund. My name's David Koch. I'm delighted to be here today with Brighter Super. I'm going to be your host today for today's webinar, but more about me a bit later when I present on life considerations in retirement. Overall, today's webinar will run for about an hour and a half and is designed to provide you with an update on the fund and its investment performance. First up, we'll hear from Kate Farrar, Brighter Super's Chief Executive Officer, who will highlight recent initiatives that are helping to make the fund stronger and more rewarding for members. We'll then hear from Mark Ryder, the Chief Investment Officer, the investment boss behind your fund, who will update you on recent investment performance, and he's going to polish the crystal ball and provide an outlook for investment markets over the coming months. It's going to be fascinating. Following my own presentation, I'll facilitate a panel discussion with Kate and Mark, and we'll also give you a chance to ask your burning questions. If you'd like to ask questions throughout today's presentation, please click on the live Q&A tab located on the right-hand side of the webinar screen. We'll endeavour to get through as many questions as possible, but if we can't get to your question, we will come back to you in the coming days with an answer. We've got so many that have been pre-submitted, which is fabulous. Thank you for sending them through, but we'll take them live as well. And I always reckon the Q&A segment is one of the most interesting. So don't be afraid to put a question through. All right, let's kick things off and hand over to Kate to get us started. Hi, Kate.
Yes, thank you, David, and good afternoon, members and guests. First of all, I would like to acknowledge and thank David for joining us today. As you will have seen from our collateral, we're working with David a lot more to improve our member proposition around things like financial literacy, education and advice to help all of you grow your super and enjoy the best possible and brightest retirement that you can. So you can expect to see more of David on our website, in newsletter articles like the ones that have just been sent out, and seminars and webinars like these. All the members I've spoken to have been really positive about our arrangement with David, and we're very much looking forward to continuing to work with him a whole lot more to build your knowledge and your confidence. Before I start today's briefing, I would like to acknowledge the traditional owners of the lands on which we're all meeting, including all of you all around Queensland, and pay our respects to their elders, past and present. At Brighter Super, we acknowledge and celebrate the continuation of a living culture that has a unique role in this region, and in particular, I would like to acknowledge the 17 First Nations councils that we're proud to serve. I'd also like to let you know that this presentation contains general advice. So it has been prepared without taking into account your individual objectives, financial situation or needs. So it's really important that you don't rely on the information we present today alone as a sole or primary source of advice or guidance for the purpose of making decisions about your superannuation options. We'll also be talking very proudly about the fund's performance in this presentation, and it is important to note that past performance is not an indicator of future performance. So, it's hard to believe that we are halfway through 2024 already, but time flies when you're busy, and we've certainly been very busy at Brighter Super. As you know, we've been on a journey of transformation to merge our three funds into one, and we're now a well-sized fund managing around $32 billion of your retirement savings. And we've made some really great progress in selecting the best possible products and services from each foundation fund to support you, our members. We're not planning to grow further by acquisition or mergers in the near term, so this year is all about focusing on ensuring our members continue to benefit from the mergers. So with this in mind, I'd like to share some of the latest news and developments that we've been working on to fine-tune our business and improve your benefits whilst maintaining our boutique personalised service. So we are committed to being brighter together. As you would have seen in our recent communications to you, on the 31st of May of this year, we took a really significant step to deliver on our commitment to improve our service offer and reduce costs for all members. The key changes are up on the slide, and they include streamlining our investment options into one investment menu for all members, reducing from over 32 options down to 12 open. We've reduced investment fees across most of our investment options. We know that's really important to you. We changed the percentage-based administration fee for all investment options to 0.18%, which resulted in administration fee reductions of up to almost 70% for some members. Quite extraordinary. We also introduced a consistent administration fee cap, reducing the cap for some members again by around 70%. So that brings it down to $900 per financial year for all investment options. For transparency, we moved to reporting direct administration fees across the board, with administration fees and tax rebates now listed separately on Member Online and in annual statements, so you can see what you are paying in direct fees. And we retired the Optimiser product name, which was created for our Suncorp Super members, and we're moving forward now with Brighter Super Accumulation and Brighter Super Pension. And this is an overview of our new single set of investment choices for all members. So until the 31st of May, of course, we did operate two separate sets of investment options, one for Brighter Super members and one for members with Optimiser accounts. But our intention was always to align our investment options in order to simplify our product offering and to save our costs. So by consolidating investment options, we also gave all members access to unlisted assets held by the fund and to a range of really high-performing multi-manager strategies. And we've made a concerted effort to ensure that all members have access to our lower administration fees, as I said earlier. So Brighter Super's My Super investment option is currently recognised as one of the top 3 industry funds in Australia with the lowest total fees. This is great news for our members, and our efforts to pass on significant fee savings are continuing. So I'm pleased to say we're planning to deliver further fee reductions for members in January 2025. As I mentioned, this year is all about ensuring our members continue to benefit from the mergers, particularly those members who are close to retirement. The transition to retirement is such an important life stage for many of our members, and it's when you need our help most. So with this in mind, we have developed a retirement income strategy. It's on the web, that is designed to help members live comfortably in retirement. The first stage of this strategy was the launch of a new product which we called the Retire Easy Pension on the 31st of May of this year. So while the investment strategy of our current Brighter Super pension account is based around flexibility and choice for members and looks a lot like the accumulation investment options, the Retire Easy Pension product is actually based on what you call a bucket approach. This involves dividing members' money into 3 buckets, with the first allowing for 2 years' worth of regular income payments, and the second and third buckets invested in assets that will continue to grow over the medium and long term. Retire Easy Pension is an opt-in arrangement which current or new members can choose, featuring pre-selected investment and payment options for your pension account that automatically update over time. Now, the default arrangement we've always had will continue to be our existing account strategy, and this is more suited to members who want the flexibility to choose and manage their own investment and payment options. We're also improving our education and servicing with access to a wide range of personalised education, guidance and support, more online calculators, more seminars and webinars, and more face-to-face appointments we know that you love in the workplace and community. And of course, our new arrangement with David Koch. I'm also incredibly pleased to announce that we are increasing our investment in Queensland, with Brighter Super planning to invest an additional $500 million in Queensland assets over the next 3 to 5 years. So cementing our commitment to Queensland, Brighter Super already has $1 billion invested in Queensland assets across diverse industries like transport, agriculture, hospitality, retail, commercial and industrial property. Our strategy involves supporting our members where you live and work, and this additional investment in Queensland assets will support job creation and economic growth, whilst also, most importantly, delivering strong returns for all of you. We have more than 85% of our funds under management owned by members who live in Queensland. So it just makes sense for us to invest in the state that help drive sustainable growth and create lasting positive impacts for our members and our communities. We're actually pretty well progressed with this strategy. We're currently selecting fund manager partners to acquire assets across direct infrastructure, property, agriculture, etc. And we are going through a really rigorous selection process, as you would expect. So we look forward to making some announcements very soon, and we'll keep you informed on our progress as we know more. So that's all from me, and I'll now hand over to Mark Ryder for an investment and market update. Thanks, Mark.
Thanks, Kate. Good afternoon, everyone. It's a pleasure to be here to talk to you today about your super or pension investments with Brighter Super. I will cover three areas this afternoon: fund performance, what's been driving it, and some thoughts on the year ahead. Superannuation is a long-term investment, and this chart shows the payoff from strong long-run returns. Looking at the My Super option, over the past 10 years, it has delivered 6.9% annualised return. $10,000 invested 10 years ago has almost doubled over that period of time. But as the chart shows, it's not without its ups and downs along the way. Through all of this, it's important to stay focused on the long-term nature of these investments. If we look at the past financial year, it has had its ups and downs as well, as shown in this chart. My Super initially fell in the opening months of the financial year before beginning to rise late 2023 on expectations of finally a fall in interest rates. The slide shows a quote from the head of the US Central Bank at the time, pointing to their thinking was moving this way. I will delve further into this in the next few slides. The next few slides will dig into the detail of what investments have driven recent performance. The chart on the left shows the asset allocation of the My Super option. The asset allocation shows the type of investments the option holds and in what proportions. There are 7 broad asset classes we use. Almost 60% of the option is in shares, 27% Australia and 32% international. The rest of the option is made up of an allocation to real assets, 8% property and 10% infrastructure, 17% in fixed income, both government and corporate debt, and almost 4% in cash. There are also small allocations to private equity, there's equity stakes in companies not listed on the share market, and diversifying strategies. This is for My Super. For other options, we alter the mix of assets. For example, the stable fund is a lower risk fund as its strategic asset allocation for shares is only 23%, while the fixed income holding is 45%. The chart on the right shows the returns by asset class over the past 12 months, the blue bars, and 18 months, the red bars, to May 2024. Over the past year, My Super returned 9.7%, an annualised 7.9% return over the past year and a half. The two equities asset classes have driven almost all of the returns in the option. Share markets rose on an improved economic outlook, and in the United States, a surge in tech stocks due to rapid demand for AI-related technology. We also saw positive returns by private equity, infrastructure, diversified fixed income and cash. In contrast, property has been the only asset class to post negative returns. Falling prices in the office sector has been the major source of weakness on the back of higher interest rates and poor occupancy in the post-COVID environment. Interest rates have been very important for share markets and financial markets overall in recent years. This chart shows the interest rate that the US Federal Reserve sets. It's the equivalent of the RBA's cash rate. Interest rates rose very sharply in 2022 when inflation picked up strongly. This was after a sustained period of very low interest rates. As a result, overseas share markets declined but began to recover as the peak in interest rates approached in late 2022. However, by the middle of last year, markets saw little prospect of lower interest rates, and as a result, share markets weakened on concern it may drive the US economy into recession. Now, as the yellow dots show, markets are looking for rates to start falling in the US over the coming year and by 2 percentage points by mid-2027 to 3.5%. Slower growth and easing inflation is the catalyst for lower rates. Australian official interest rates followed a similar trend, but ultimately have risen to date by less than in the US, standing at only 4.35% versus 5.5% in the United States. Looking ahead, interest rates are expected to be little changed over most of the coming year before falling around 0.5%, as shown by the blue dots. Australian interest rates in time are expected to be broadly in line with the United States. Interest rate cut expectations in Australia are more modest than in the US, as the rise in rates was less. There is even talk of the risk of them moving higher due to sticky inflation and no slowing in wages growth. But the economy has slowed. It looks to me as if interest rates are going to be little changed for an extended period of time to deal with stubborn inflation. Along with the prospect of lower interest rates, the other key driver of the 40% rise in the US share market, the red line in this chart, has been the so-called Magnificent Seven tech stocks. Combined, they have risen by 173% over the past 18 months. They're shown by the blue line. Combined, they have a market value of $13.7 trillion US dollars, 29% of the benchmark US share market index, the S&P 500. The US S&P 500, excluding these seven stocks, the grey line, is only up 24%. Over this period of time, the ASX has only risen by 10%. The Magnificent Seven tech stocks are not all equal in their magnificence. The leader of the pack is NVIDIA, who is at the forefront of the AI revolution for its graphics processing units, which are critical for the computational power needed in artificial intelligence. All the other companies have lagged NVIDIA. You are likely to have heard of most, if not all of these companies. They are listed at the bottom of the chart. There's Microsoft, Meta, the owner of Facebook, Amazon, Alphabet, the owner of Google, Tesla and Apple. NVIDIA has risen 750% in the past 18 months and is now the world's most valuable company. But even the laggard of the seven, Tesla, is up by close to 50% over this period of time. We believe a structural change in the US market is underway and there is real earnings behind the surge, particularly for NVIDIA. But no matter how good a company is, you can pay too much for it. And that is what we and our managers are very closely looking at. So, what's next for financial markets and your superannuation? At the centre of our thinking is the economy. It provides the profits for companies, which underpins share prices and the wages for households that support consumption. The economy's technological development drives innovation, growth and investment opportunities. Government policy has many objectives, but a very important role is keeping a good balance between total demand and supply in the economy. If inflation is high, it indicates too much demand, as is currently the case. The RBA's interest rate policy is focused on this balance. The government's budget has this as one of a range of policy objectives. It is the interplay of these forces which is critical for financial markets. This slide is a good example of the impact government budgets can have on financial markets. The blue columns show the annual return of the US share market in the years when an incumbent president in the United States is standing for re-election, as is the case with Joe Biden. It shows that in such years, the share market typically increases. This has happened the last 13 times in a row. Why is this the case? In an election year, an incumbent president is incentivised to spend money to support their re-election bid, and strong growth, in the short term at least, supports share prices. But if demand is too strong and inflation higher than targeted, it can be a problem. This chart shows that both Australian and US inflation have fallen in the past year or so. However, US inflation is lower and there are clearer signs of easing in forward indicators relative to Australia, where inflation is higher and looks sticky. This may reflect the US interest rates have been 1% higher than in Australia for an extended period. That is, monetary policy has been tight. It's worth noting that China is in a completely different position, with its weak economy resulting in deflation. Domestic as well as global factors are important in driving inflation. In summary, because of this, it looks to me as if the US will ease interest rates in time, while the RBA is likely to be hesitant to follow this lead anytime soon to restrain economic growth. In conclusion, we've had solid returns in our investment options over the past 18 months, particularly where there has been a large allocation to growth assets, such as shares. This is despite high interest rates and slower economic growth. This reflects expectations that interest rates will fall in the next year or so, having done the job of dampening inflation. Overseas, there has also been the surge in tech stocks related to artificial intelligence. Other asset classes have supported returns, except for property. But we're not entirely out of the woods yet. Equity valuations are not cheap, and we still need inflation to fall further to ensure rate cuts are forthcoming. And this all happens at a time of trade wars, military conflict, a rising new great power in China, and the energy transition. It makes for an uncertain world. Our focus is on building for you a well-diversified portfolio, selectively using active management to help navigate these uncertainties to generate the returns you need for your retirement in the years ahead. I'll now hand over to David.
Thank you, Mark. Gee, some really good insights there from Mark, aren't there? And don't forget, if you've got any questions for either Mark or Kate, that's coming up very shortly, and we'll try and whip through as many as we possibly can. But before that, I just want to cover a couple of things that I think you should be considering in terms of retirement and how to get good advice, because I always say the best investment you can make is getting good advice. You don't need to make all these decisions by yourself. So just to give you a bit of background on what I've been doing post-Sunrise, I retired from Sunrise, loved every minute of it. As all of you who do shift work know, that it can wear you down a bit. And after 21 years of getting up at 3 o'clock, wore me down. But I've always had my own family businesses, so I basically work business hours at the moment. I'm the economic director of Compare the Market. I chair the Port Adelaide AFL Club. Yes, we haven't been playing that well, but we're still in the 8, gives me hope. And I invest and mentor quite a few startup companies and disruptors as well. But why am I associating myself with Brighter? Look, when I left Sunrise, a lot of financial institutions asked me if I can help them along the way. And when I delved into Brighter, it was just an organisation that really has very similar values to me. I've been a bit critical of big superannuation funds in the past because I don't think they're really transparent to members and treat them more like a number rather than sort of a friend, associate and a client. And that's certainly what Brighter does with the amount of information it discloses to their members. And this webinar is a perfect example of communicating with members so you know exactly where you stand. And the fact that they offer investment advice and advisors through superannuation health checks and the like, I think just provides great service and great opportunities for its members. So I love the open book approach from Brighter. So I'm really looking forward to our association going forward. But as I was saying, when you're planning for retirement and going into retirement, it doesn't have to be just about you. It's about building the right team around you. Because let's face it, retirement can be stressful. I met quite a lot of members this morning at a function I went to, and I walked out with one bloke who said, I plan to retire in 6 months. He'd just done his retirement health check last week, would you believe, with Brighter. He said, because I was stressing out on what I was going to be doing in 6 months' time. And so now he's got a plan not only financially, I also asked him about the emotional transition of working and then not working. And he went, yep, I listened to on the last webinar. And so he's chatted with his partner about building what they're going to do as a couple in retirement. And I think that's really important. But he stressed the fact that he didn't need to do it alone. And that's made him so much more positive about what's ahead. So start with making sure you and your partner are on the same team. You're a team in love, in life, and also in finances as well. And you've got to be working on the same page. So put aside a fair bit of time. Lib and I do 15 minutes every month, would you believe? We usually do it with a glass of wine and some cheese and crackers to talk about any financial stresses that we have in our life and share them. We set goals for the future and we check on the progress of getting to goals that we've discussed before. It's really cathartic and really comforting to be on the same page. Tap into the knowledge banks online to help with your household finances. There's so much information online to manage your own expenses and life. You've got comparison sites to check everything that you're doing. Get a financial advisor to build an investment or wealth roadmap for you, to work through the different options that are suitable just for you. To hark back to this session that I did this morning with some of the members at one of the councils here in Brisbane, got a wonderful question from a lady who'd been out of the workforce for 10 or 15 years, really has no superannuation, looking at retiring in 15 years' time. Kelly, one of the brighter advisors, just came up with some thought starters to think about on how she could boost her retirement savings over the next 10, 12 years or so that she plans to work for. And that will give her something to think about before she has her retirement health check. And the other big area is to get good advice on estate planning. You know, you work so hard to build up your wealth, to build up your assets, and you've got to really protect what you've got and what you've built up. I have so many people ask me, what should I do with my money? And my first question back to them is, well, how are you protecting what you've already got? And estate planning is a really important part of that. So you don't need to go into retirement and plan for retirement by yourself. Yes, it can seem complicated. Yes, it can seem really above everybody's pay grade, and often you can't understand some of the gurus in the information that they're giving you, but you don't need to. It's all about building those great advisors around you as a secret. As I said, I do my 15-minute monthly partner check-in with Lib. The questions we ask ourselves, usually it goes beyond 15 minutes. We set the 15-minute time, but we end up finding that we have so much to talk about. And we have an agenda which says, what do we need in the next 12 months, the next 5 years, and when I retire completely? So the basics, what do we need just to sustain our life and fulfill our lives? And then we get on to what do we want for the next 12 months? That's always the fun part. 12 months, 5 years when I retire. The good things in life. A lot of people say to me, when I retire, I just want a basic retirement. In my mind, blow that. I want a good retirement and a retirement that I can really enjoy with the kids and the grandkids. So then we prioritise the wants and the needs. We work on a household budget to target those priorities. Lib is the world's best manager of a household budget. She goes through line by line exactly what we're spending. She has sort of lots of rules: never renew an insurance policy, always check that you've got the best in the market, constantly look at those line items. Our meeting also outlines, as I said, each of our financial stresses, because they could be different. We could be bottling up different financial stresses, and that's never good for a relationship. You don't want to be losing sleep or getting grumpy with each other over financial stresses. Be upbeat, and then as a team, be upfront as a team, work to resolve them. And also set financial habits that you both agree on, because everybody is different. We all have different spending patterns and saving patterns and the like. Get on the same page and make sure you're doing it together. One of the big things is how to get the best deals on your household bills, particularly in a cost of living crisis. We really need to make every dollar count. Knowledge is power, and it's so easy to benchmark everything. If you have a home loan, have you been too loyal? The Reserve Bank did a survey, did a research study on what home loan interest rates were that they were charging new customers against home loan interest rates being paid by loyal existing customers. They found it can be as much as 1.5%. That's 6 Reserve Bank 0.25% interest rate increases. That's the difference. So ring your bank, ask for a discount. If you've been a loyal customer of a bank and you've never asked them for a discount on your home loan, pick up the phone, do it. Energy plans in the last year going through the roof. Understand that if you've got a good deal on an energy plan, it only lasts for a year and then reverts to an industry rate. The best energy hack I can say, and I know Queenslanders, you're getting your $1,000 energy subsidy, more than any other state in the country, which is great news. There's a little panel on your energy bill that you get every month that the regulator insists your energy retailer put there. And that little panel is your energy retailer looking at your usage and telling you if there's a better plan where you can save money with that energy retailer available to you. So they disclose it in the little box. 9 out of 10 people that I talk to about this have no idea what I'm talking to. You go and do it now. Look at your bill. You'll see the little box. And some people have said to me they've saved up to $400 a year on their energy bill just by switching plans within your existing provider. But you've got to instigate it. The energy retailer is obligated to tell you about it, but you've got to action it. Do it now. As I said, Lib says never renew your insurance policies without checking online, making sure you got the best deal. Health insurance, are you paying for what you need? I've always thought as an old person I needed the top health cover, private health cover, as gold cover. Lib for years was telling me we're paying too much. Silver gives us exactly the same options and coverage. She was so frustrated in me not believing her that she sat me down and did a presentation, and the only difference between gold and silver was coverage for obstetrics and paediatric. Lib and I think we're young for our age, but we're not going to have another baby. So we didn't need that cover, which we were paying a fortune for. So we switched to silver. Make sure your coverage is suitable to you. And same with your home and contents insurance. All of those savings can help you not only balance a family budget, but also be able to put more into superannuation as well and plan for your retirement. So, and the other big issue that I'm getting from a lot of members is the bank of mum and dad. Call me a bit of a grumpy old man on this, but my view is it's our money, not theirs, with the kids. Yes, we want to help them with big ticket items like buying a first home. It is tough, but it was tough when we were buying a first home too. It's tough for anybody to buy a home. I used to complain about my father in exactly the same situation. Intergenerational wars have been going on for decades. So, yes, we want to help them out, do the right thing, but do it in a way that protects your assets and helps you fund for your doesn't put your retirement lifestyle at risk. Provide a loan to them. Make it formal, not a gift. It's a financial relationship, so act like a bank. Make sure it's in writing. If they're financial gifts rather than a loan, remember your child's partner gets half of that gift that you give to a couple. That makes you think twice. As an alternative, rather than giving financing, go guarantor for their loan. It saves on mortgage insurance, might get them a better rate. But make sure that guarantee is limited with an end date or a trigger event. Just don't make it open-ended. Banks love that, knowing that they can hold you totally responsible for a loan of your child if something happens. So make sure it's limited, has an end date. And if you have an adult child who wants to borrow money from you for a business venture, then treat it like being an investor or a director. Ask yourself why they can't get the money elsewhere. If a bank doesn't have confidence in the venture, why should you? Put in all of the protections. But lending money to adult children at our stage of life in retirement can really come with a lot of not only financial jeopardy, but also emotional and relationship jeopardy as well. So finally, build a relationship with a financial advisor. Brighter has a complete team. Obviously, be satisfied with their credentials. Be very open on what you expect from them, and agree on a plan or routine. And when you go to that first session, be prepared. Have details of your income, your financial assets, your family details, your budget and income, any unusually large items of spending that you might have planned in the future, possible lifestyle changes. Be completely open and honest, and that way you can come up and agree on the best course of attack for you with your financial advisor, and you make the most out of them. So there's some thoughts from me on what you should be doing in terms of planning for retirement. As I said, estate planning is we don't like to think about dying. Get good advice. Understand one will doesn't last a lifetime. It constantly evolves. Marriage cancels a will, divorce doesn't. That scares a lot of people. There are capital gains tax implications. Choose the right executor. You can have more than one, and then tell your family about it, where the will's located, and for goodness sake, don't attach anything to it that might cause a dispute within the family. So hopefully that gives you some thought starters on getting good advice, how to plan better for your household budgeting, and also thinking about estate planning. All right, let's get on to some of the questions that have come through at the moment. And if you have a question, please click on the live Q&A tab located on the right-hand side of the webinar screen. We'll get through as many questions as we can. To kick things off, let's start with a question for Kate. And Kate, you talked about the percentage-based administration fee. Is that for all investment options?
Yes, I'm really happy to say that now the percentage-based administration fee of 0.18% is available on all investment options. And as I said, that resulted in administration fee reductions of almost 70% for quite a number of our members.
Okay. Mark, you're a Queensland-based fund. I notice in one of the slides there, your slides, the investments throughout Queensland. You love airports. You've got an interest in virtually every airport in Queensland, from Sunshine Coast to Townsville and the whole lot. Is that a big consideration for you, investing in Queensland?
I think firstly, we always invest in assets with the filter of working members' best financial interests. That means that any investment must first be appropriate, both from a risk and return perspective. So that's our starting point. But we do have assets in regions where our members live. For example, the members online today, we have heard of investments such as the Queensland Regional Stock Exchange. We've got shopping centres, the Hyperdome in Logan. We've got Stockland, Townsville. We've got Grand Central in Toowoomba. The Village Roadshow theme park land is owned by the fund, Port of Brisbane, and the North Queensland Gas Pipeline. So we've got a real range of investments across the state, and it's a win-win. You get a great investment, and it helps the local community. Yeah,
that's terrific. It's Kate, before you mention you're investing a further $500 million in Queensland, when do you plan to start that?
Yeah, thanks for that. Look, our planning is really very well underway already. We've started to work with a short list of investment managers, some new, some existing, like QIC, to target the best possible assets across a range of different asset types. And as I said earlier, our Queensland asset strategy is intended not only to give great financial returns, as Mark said, the cornerstone of how we invest, but also to support the creation of jobs and add to economic growth in Queensland and in local communities where members live and work. And as I said, importantly, we're going to be adding to our members' portfolios at an exciting time when the state's really gearing up to host the Brisbane 2032 Olympic Games. So our plan is to do this in a way that resonates with our members, enhances your communities and creates economic impact and jobs. I've been talking constantly, as you can imagine, with Mark about when we're going to start doing this, but certainly we're looking forward to making some announcements before the end of the year is our hope. There's certainly some very well progressed projects in there.
Okay, that's great news. Mark, let's talk the economy. You touched on it briefly. Inflation, interest rates going forward. Now, on behalf of all baby boomers, we're being accused of driving inflation. Is that a myth or is that right?
Look, inflation's a global problem, not just in Australia.
Right.
It is an interesting question and one which seems to be sort of incredibly topical as the question you're asking here today. We do see a lot of spending in various reports being attributed to this demographic. But if you look at over the last few years, services have remained strong as opposed to goods, which have decreased dramatically since COVID. So there may be some impact there, but we're also seeing resilient in Australia, particularly versus the United States in goods here, a little bit higher. But I don't think we can blame the blame for just at the feet of the boomers. But,
good to know.
But it's across the board. But there are distributional issues to do with higher interest rates and assets which are playing out. But no, I don't think we can just blame the boomers.
Good. It's a good answer for my adult children that complain to us about that. Look, on inflation, explain the impact of energy prices in more detail.
The cost of energy, especially oil, has been volatile over the past few years, and that's been due to worries about disruptions in the world's energy supply. Geopolitical unrest contributes to this concern. Russia, for example, is one of the biggest oil producers globally, and the recent problems in Israel and Palestine have raised concerns about what could happen to the energy sector if things really deteriorate there. When energy prices increase, it can push prices up for everything. It makes consumers cut back on spending as they must spend more on energy. It also affects companies as they use a lot of energy in production process which reduces profitability. It's not an ideal environment where we're trying to reduce inflation to actually have another factor pushing it up.
Yeah, although I notice as well, which is great news, except in South East Queensland, but every other state, the electricity reference rate for the next 12 months has dropped in most states, which hopefully that flows through to lower inflation, which will be good.
Things have come off, but they're still relatively high compared to where they were.
Yeah. Kate, given the importance of retirement savings in their environment where the cost of living is rising, how important is it for members to get some help and advice with their super and retirement planning?
Yeah, we've been doing some work actually to dimension the value of financial advice, and I have to say it absolutely staggered me to see how much additional balances members can have at their retirement if they take financial advice on their superannuation and retirement planning early on in their careers. So at Brighter Super, we have doubled down on advice, and we really want to try and help all members, in fact, to retire with advice. We have a whole lot of different offerings. So in addition to our super health checks and also our new retirement health checks, we have a team of 18 in-house comprehensive financial advisors who offer a range of personalised advice services for members who are after a more in-depth analysis of their financial situation. Financial advisors, there's no question, can help members to grow their super and achieve a more comfortable and brighter lifestyle in retirement.
Kate, you've also got a number of members. What is Brighter Super doing to make sure many members as possible retire with advice?
Yeah, so I've just mentioned some of the advice offerings that we have internally, but very exciting thing for me is that we are now able to support members having choice in accessing an external financial advisor, and that's one of the benefits of our Suncorp Super acquisition. So we now have over 1,300 external advisors who are registered with us. We have an online advisor portal and a dedicated contact centre team. And in fact, we spent some time yesterday talking about continued uplifts that we intend to bring to our support for external financial advisors. External financial advisors, with the members' permission, can access information on our members' account to enhance their services to their members. And in fact, we can allow them to withdraw fees from members' accounts so that it's no impost in this high cost of living environment.
Yeah. Mark, as part of your presentation, you were talking about the global environment, some of the threats that investment markets are dealing with at the moment. You mentioned the Middle East. How will a deterioration there affect our super?
It's an evolving situation, but I think how whether it improves or whether it worsens, it can undermine the outlook for growth assets such as shares, and it can push interest rates higher. It does this by actually increasing uncertainty, just in general. It also does it by the impact it can have on oil prices that I just discussed a question or so ago. That higher oil prices cut demand, they push up inflation, and given oil in particular is so integrated into the cost structure, it works its way through, and that's generally the size. People have got less money to spend, companies have got less profits, interest rates have to go higher, and that's the way that it generally works out, along with that confidence impact.
Okay. Let's move from the Middle East to emerging markets and also to China. How do you see them, and what exposure does the portfolio have to emerging markets in China?
Emerging markets are around 5% of the total equities portfolio, which is around $18 billion. So of this portfolio, 20% is domiciled in China. So it's not large. So working at around sort of $200 million. And so in itself, it's not a big exposure. But I think from the exposure Australia gets is more not by what we've got invested there, but the demand that they have for our companies in Australia.
Yeah, of course, China is our biggest customer.
That's
Takes about a third of our exports still. So what do you think of the slowdown in China, and how will that affect returns?
If you just look at the share market has declined by around 40% from its peak over the last 4 years. It's picked up a little bit of late, but not all. But really, what it comes down to is the dynamic. Not that long ago, China was growing around 8, 9, 10% per annum, and rapidly increasing its demand for iron ore and coal and the like. When we look at China now, I think China's driven its economy by exporting in the rest of the world and construction. It's currently attempting to unwind probably what some are calling the biggest property bubble ever in China, while the rest of the world isn't particularly strong. Its economic growth is a lot weaker. Its growth model, the way it grows its economy, is changing. And I think we've got to have expectation that while it is a huge economy, the second biggest economy in the world, it's not going to be growing as quickly as it did. So that has implications whether for a BHP, a Rio Tinto, or for the Australian government, which raises a lot of tax from the corporate profits earned from those companies. So that's been the big story for the last 2 decades. It's not going away, but it's changing.
Because there's a lot of doom and gloom about China at the moment, isn't there? Does it also present opportunities?
Look, there certainly are opportunities there. One of the things China is attempting to do is to grow its technology. So in the technology sector, whether I suppose we could be importing the goods, or whether we're playing a part in production there, it is attempting to grow its economy through technology, through these difficulties. But from a big picture perspective, the type of growth that we've been experiencing, as that rapid commodity demand growth has gone.
Okay. Kate, back to you with the investment options. You were explaining you've streamlined your investment options, reduced them to over 30 to 12. Once members explore the investment menu, can they select a different investment option?
Yes, absolutely. And in fact, we do know that member sort of preferences and risk appetites change over time. So we've made it very easy. Members can switch some or all of their balance using the new set of investment options by logging into our member online portal and completing an online switch. Or actually, of course, we still have an investment switch form in paper if that's what you prefer.
Okay, it makes it easy, does it, to take an interest in it. Mark, there's not a crypto option. Do you invest in cryptos as a fund manager in the big fund?
At this stage, we're not considering and we're not invested in crypto. In our investment process, valuation of any asset is critical. And regarding cryptocurrencies, with there being no underlying cash flows related to the assets, like the earnings of a company, and therefore you can use that to value the share, we find valuation can only be based upon a speculative view, not grounded in fundamentals. We also consider, does it bring benefit as being a diversifier of risk? And this is an area where it was promised before, or not promised, but I suppose the idea was it would diversify your portfolio. It would do well in high inflation periods and diversify.
Sort of an option to gold, some people were saying.
It was, but the reality is what we've actually found is that it's behaved more like just a highly levered version of the share market. It goes up more when it goes up and goes down by more. So on both fronts, we can't value it properly. And it doesn't really bring, we think, an additional aspect to the portfolio in terms of diversification. We're not investing in it at the moment.
Okay, that's interesting. Kate, something else that makes account management easier is the new online member reports function. How can members take advantage of that? What's the value?
Yeah, it's a fantastic function. I was having a look at it the other day. So accumulation account members can now download reports about their account at any time during the year. So you no longer have to wait for your annual statement. Just think about what's on the annual statement. That's what's on the member report. So if you log into your member online portal and select member reports from the menu, then you'll see you can choose the dates, you'll see it right there. Importantly, our listed financial advisors, the external financial advisors that you choose, can also generate a report and talk you through how things are going if that's what you wish.
Okay. All right, let's get a question from John P. John is asking, do you have the capability of accepting an existing SMSF? I mean, transfer it from an existing accountancy company that administers it, also with a view to dissolving the SMSF?
Yeah, that's a fantastic question, and we would love that. It's very easy, in fact, to roll funds from an external anywhere, really, roll funds into Brighter Super. And the best thing to do is to call in to the contact centre. We'll get one of our team to talk you through the exact mechanics.
Okay. It's as easy as that, John. Thank you for your question. We've got a pre-submitted question from James. Can you please explain the reduced investment options that have recently gone live? Why reduce them?
Yeah, that's another very good question. So every time we have a different investment option, we have to do a lot of work associated with that. And that can be around reporting and disclosure. It can be around performance monitoring, etc. So what we've attempted to do by building the investment option structure that we have here is to provide you with enough choice that we can cover all of the appropriate risk appetites, but just to make it simpler and cheaper. We also get fee benefits as we put more funds with different investment managers. And overall, as I said, this is really what is going to allow us to deliver further administration fees towards the end of the year. We've already delivered the investment fee cuts, as we said, on the 31st of May across the majority of our investment options. And we will, as a result of the cost savings, also be able to deliver appropriate administration fee savings on the 1st of January of next year.
Mark, one for you from David S. What's the difference between property and assets, as property is the only asset that is negative, and airports and shopping centres are where you're investing, are they not property? So I think David's asking, how do you define them in terms of the allocation in the portfolio?
Yeah, it can be there's a spectrum of what can be regarded as infrastructure and what can be regarded as property. But generally, when you can consider property, what's in the property portfolio? Well, the office towers, and so what is owned is the office tower, but it's not the businesses which go on in it. It provides the office there to be used, but it's not actually engaging in the business within it. That would be property investment. When you think of an airport, that's infrastructure. So our 50% ownership of Sunshine Coast Airport, what are we getting that? It's the whole asset, and it's actually being operational. So it's not, if a property asset on that could be, you could own a shed on it where they were putting the aircraft. And if that was the only investment you had, that would have been regarded as a property investment. But when you own the airport and it's an operating business, that, because it's an infrastructure asset is one where you've got your planes flying in and out, you're getting regular payments.
Yeah, you get landing fees, all that fees. Sort of stuff. So it's in the business.
It's in the business, and that's the difference between it. It's important to keep that in mind, because it's really from owning an asset, which say a built office, to actually, when you've got an infrastructure, it's not just an asset, it's actually business.
Right, okay. Kate, Craig wants to know, are you planning any new retirement income products other than the one that you talked about today?
Yeah, absolutely. It's a big focus for us at present, retirement, and making sure that we provide the best services and products possible for our members as you move into a retirement period. So what we are working on at present is what you call a longevity product. So that is effectively allowing members to have certainty that there will be some type of income no matter how long you live. Because whenever we talk to members, it's clear that this is one of the biggest worries that members have. That can match in, obviously, with our current product that we have issued, the Retire Easy Pension, which kind of looks at the stages of retirement. So for now, we've got the cash, and then we've got medium and long-term sort of growth options in there as well. And so what we're really looking to do is to provide options for members as you come into retirement, as your needs change, and to really deal with all of the risks and concerns that we know you have as you get to that stage.
Kate Ann is pushing 60 years of age soon, and you're a spring chicken. What amount would be a good amount to target for retirement?
Yeah, that's a question we get a lot, actually, and thank you, Spring Chicken, for asking that question. So look, of course, what is a good amount depends on what you want to do in retirement, and so David has spoken to you about deciding how you want to retire and, you know, prioritising your needs and wants, and all of that makes a difference to how much is important to you to retire with. So I guess a couple of services that we offer that I would definitely have a look at. So first of all, on the web, very easy to access, is the Retirement Income Calculator. A lot of information in there about, you know, how much you need to retire with a certain amount of income. That'll just get you thinking, I think. There is also on the ASFA website, there is an assessment of how much you need for a comfortable or for a modest retirement. But actually, I think because everybody's preferences are different, a really great thing to do is to have a retirement health check with one of our advisors. It's a pretty cheap offering. It's $330. I've just had one myself, actually, because I wanted to see what it was like. And what it is that they take all the information that you have about your assets and your sources of income, feed it into a calculator and talk to you about what that is likely to provide at the time when you're going to retire. So retirement health check, definitely worth having a look at.
Yeah, just as an extension to that, Kate, a lot of members are asking, for those looking to retire within the next 5 years, what do I need to consider now?
Look, doesn't matter when you want to retire, the best thing to do is to consider how much you can put in. So, you know, we talked a little bit about the benefits of returns over time, the value of compound interest or the value of compound returns. The more you can put in earlier, the better off you are going to be. So the best thing to do really is to talk to one of our team. You know, we do provide fantastic specialists who'll talk to you about this. We have super health checks, which you can have a look at, book online. We have the retirement health checks, which I spoke about. So contact the fund and see if you can have somebody who will have a talk with you about what are the options available for you right now, because it is a very personal experience, retiring, and everybody retires in slightly different circumstances with different balances, different assets outside superannuation, whether you're married or you're not married, you know, what do you want to do, your preferences, your feelings about risk, all of those things do need to be considered. And so I think the best thing to do is to have a look on the website, contact the fund and get one of our team to talk to you.
Because it's good to talk to a human being, isn't it? Because it's not just financial, it's the whole emotional side of retiring, and talking to someone about it can really put you at ease.
Yeah, and that's what Brighter Super does differently from any other fund. I have to say, it really struck me when I first joined Brighter Super, and it has continued to be a really important thing for us, that what we do is to provide, you know, face-to-face, individualised, personalised advice and guidance that is important for you.
Yep. Really holistic approach, which I think is fantastic. All right, Mark, Koch, Stephen and John want to know, how can we prepare for possible recession and impacts on our superannuation? Number one, do you think we're going into recession? Do you think the world's going into a global financial crisis? And how can you prepare, insulate your super from it?
In terms of whether there's a recession, there's no doubt that economic growth has slowed both here and overseas. Yep. Where we go from here is going to really come down to whether inflation eases further. And I think Australia is probably in a bit of a different, slightly stickier situation than the United States, where some of the lead indicators are rolling over, their productivity looks better, and inflation is actually lower. Here, inflation is higher and lead indicators aren't as good, so the RBA is likely to hold on for longer. The positive, though, is rates are lower, and as one of my earlier charts showed, that really what's happening is the US is easing, but in the next 18 to 24 months, we're coming together.
Right.
The resilience has generally been seen as surprising. A year ago, expectation there would be a recession. From an Australian perspective, it's no doubt that it doesn't probably feel great, because if you do a per capita number for what GDP economic growth has done, it's actually been going backwards for a good year or so.
So that's not taking into account the big migrant
That's right.
Sort of 500,000 new customers coming into the economy. If you took them out said like for like, we'd be in a recession.
That you would be in a recession in that sense. So it doesn't feel great, but the economy is sort of holding up. It's still growing. Overseas, it's growing. China is still growing. Europe is perking up a little bit. So there is weaker growth there, but at the moment, it's certainly not definitive that there's going to be a recession.
And we're asset rich and cash poor, aren't we? Sort of where things feel really tough, but property values are still going up and unemployment's still pretty low. So you sort of have this cash crunch that household budgets are in, but we still seem to have a job, and one of our most valuable assets is still going up, which is, thank goodness.
That's right, and I think if you look around, one of the reasons why, to a lesser extent here, why growth has been stronger in the United States, the budget deficit there, the government's spending 6% of GDP, the size of the economy, that it doesn't actually raise in tax revenue. It's spending big to keep the economy growing. Right. Part of that's to do with, well, as I talked earlier, that there's an election, but it's also to do with they're attempting to onshore things, and so they don't have to rely on overseas. They want to bring technology back to the US,
right.
Build semiconductors in the US rather than rely on Taiwan. They're doing all that. Here, we're running probably a bit of a budget surplus, but the government is putting money back in that it could have kept. And so there's a bit of support coming through there. Rates are lower. The Aussie dollar is lower as well. That's probably a factor which normally when I'd normally expect the Aussie dollar, when you get commodity prices like they are, they've come off their peak, it might be more like 80, not 67. So there are positives and negatives at the moment in Australia and around the world. And whether Australia goes into recession, I think ultimately depends upon whether the rest of the world does.
Okay. Kate, Rick and Catherine have asked, do you offer a bonus when transitioning to pension phase?
Yeah, that's fantastic. Well, yes, we do offer our retirement reward and our newsletter, which is just going out at present. I just got mine yesterday. Wonderfully, it announced our new rate of 0.8% of the growth assets. So that's very exciting if a member is retiring from a Brighter Super accumulation account, converting into a Brighter Super pension account. We do offer a bonus, our retirement reward of 0.8% of the growth assets in the accumulation account investment option. So it's really nice to have that little bit of extra money going in.
Yep, great. Keep the questions coming. We've got some terrific questions so far. More to come, so just go to the question box on the screen there and they'll come straight to us, like Trevor C has done, Mark, who asks, why continue to invest in property if the return is negative?
At the moment, when you look at our property portfolio, around 3/4 of it is invested in, it's unlisted, where their buildings are not traded on the share market. We also then have a small amount there. So we've invested in these for long term. The reason why we're there is because over the longer run, and clearly this has been a tough phase for, particularly in the office sector, they have provided good, strong returns to the portfolio and provided a good deal of diversification and stability. It is going through a rougher spot at the moment, but we're probably at the point in the cycle now where we're starting to look for the opportunities as prices have come off. When do things actually go too far? And that's the case in terms of thinking about buying a property. But also, if you think of other parts of the portfolio in the debt side of the portfolio as well, there are higher returns there as actually you can potentially lend to companies as well who are sort of got property, but you get a very good return there. But in terms of the equity investment in property, it's one where now the thinking is beginning to shift. There's still a way to go, but it's one where over the longer run, there are good areas to invest. There are parts which have been performing quite strongly. Areas such as data centres, which is one of the assets, can be in infrastructure, can be in property as well. Yep. But that's rapidly growing demand because of what's going on in AI. They're good areas. Health is another area where there's given COVID and trajectory of technology, health is a good area. Retailing is an area where it sort of got a lot of its bad sort of weakness through the COVID when no one could go in shopping. It's better. So there are opportunities starting to arise that we're interested in looking at when we look ahead over the next few years.
Because it's not as simple as saying, oh, gee, property's in a downturn, I'm just going to get out of property altogether, is it? That's not what good investment and fund managers do, is it? They might trim the allocation, but you've got to have exposure, don't you? And you've had some of those properties for a long time.
Yep, that's right. We've had, but the thing is, I'd like to say that we have a perfectly clear crystal ball, but we don't. We can't work out exactly what's going on. Look, being honest here, it's not perfect. So the thing is, if you were 100% certain you something was going to fall, well, you wouldn't invest in it. But there's a degree of uncertainty in the world, and so what we look to do is build portfolios which can deal with the different environments which may arise in the future, and that's about having a portfolio which is diversified, different asset classes which will perform in different environments, and that's what we're looking to do. So it's not about completely divesting from asset classes. It is about trimming and adjusting, whether it's the strategic allocation we have, whether it's something more tactical. But it's one where we look to stay invested, but then move our money to where we see the better longer run returns.
Right. Okay, another question here from Peter. What's the outlook for international markets over the next 12 months? and can you generalise, or do you...
It's interesting. When at the moment, if you look around the world at share markets, it's probably a good distinction here is between it's not its own market, but it's pretty big. I spoke about earlier was the Magnificent Seven, that group of technology stocks. If you look around Australia, if you look at Australia, you look at Europe, you look at the United States, the strongest part has been in those 7 technology stocks, and particularly Nvidia. The rest of it has been okay, been returning, but it hasn't been anywhere near as strong. So there are, when you're looking at global share markets or the US share market, whether it goes up or down is going to be driven by technology to an extent. But there's also, but the rest of the economy as well is going to be, and the rest of the market are going to be driven by other sort of non-technology areas. So for us, I think it is one where, look, there's been very strong returns. It's probably fair to say share markets around the world are not cheap. They're not a bit of expensive here in Australia. The US is probably looking a bit more stretched. We think that the return outlook is, given the environment we have, is one where the moderate terms seem to be possible. But really the big swings are probably going to be driven up and down by the technology story in at least the nearer term.
And there are just so many. So the technology story has a ripple effect through so many other industries, does it? I was reading some stuff the other day that just the amount of energy being sucked out of the power grid by data centres and AI to do an AI search, sort of a chat GPT search, takes 10 times the energy of a Google search. And just NVIDIA chips, the stress it's putting on grids around the world that are transitioning to renewable energy.
That's right, and it's all at the time when we're looking to electrify everything else which has already been existing as much as we can. So it does ripple out because the technology is ultimately, we get higher real incomes by producing more for less input. It's that technology which enables us to work faster, to work smarter, and given that, it does ripple its way through clearly directly in those who are maybe making the technology, but it's when it works its way out, which it is, as companies are starting to use AI. It's not just the producers of the equipment, but it's also the users, and that's the way. Go back into the 90s and as we saw the internet arise, we saw it then, and we'll see it again, that it spreads out and has big economic impacts.
Yeah, just fascinating. Don is asking Kate, does Brighter Super have any plans to grow by way of further mergers in the future?
Yeah. Obviously, that has been our growth to date, but for the moment, we don't have any plans to grow further by merger. We're just focusing on making sure that we deliver you the benefits of the mergers that we've had. And obviously, the recent consolidation of our investment options was an important step in that. It's actually the end of 4 years of just relentless consolidation. I have to say the team's worked incredibly hard. And so really the focus now is on making sure that we deliver fantastic performance, that we deliver on our fee promise, which is another fee reduction on the 1st of January of next year, that we keep a focus on delivering retirement products, that we streamline our advice to you, that we have great communication, and that there's always the information that you need at your fingertips. So it's actually a really exciting time for me, not to be focused on this kind of very, very military delivery of the consolidations for a period of time and making sure that you get the best out of what we've done.
Kate Charlie is asking, what happens to my super account if I unexpectedly pass away?
Yeah, that is a very important question, actually, because we were looking at what we call our beneficiary nominations the other day, and they are too low. So if you have a binding beneficiary nomination, then the trustee, Brighter Super, does not have to really make a decision, I have to say. And so your beneficiary gets paid quite quickly. If you do not have a binding beneficiary, then the trustee has to effectively make a decision on your behalf. In the past, we have had different types of beneficiary nomination. So we've had preferred beneficiary that does not bind the trustee. And we've also had a thing called a lapsing binding beneficiary nomination, which expires at the end of 3 years. Now, because we haven't, as a fund, not all of the predecessor funds have had these binding beneficiary nominations, we have a lot of our members out there who actually do not have continuous, ongoing binding beneficiary nomination. And if there's one thing that you can take out of today's webinar, please go and check your binding beneficiary. Make sure that you've got one. We are going to be launching an online binding beneficiary nomination form later on this year. We don't have it at the moment. It is by paper at present. But it is so important that you do that, because then we don't have to make a decision. You know that it will go to whoever you want it to go to, within reason. There are rules. We know that you can get paid really quickly. So if you have a binding beneficiary nomination on foot, it gets paid to them very quickly. And if you don't, it's a much more torturous process.
Yeah, that is really great advice. Keep the questions coming, everyone. We're whipping through them at the moment. Still got a lot to get through. Plenty of time for yours, though, as well. Francis wants to know, Kate, will you be offering a socially responsible investment option again in the future?
Yeah, thanks for that question. Look, we made the difficult decision to close our socially responsible investment options that the predecessor funds established on the 31st of May. And the reason for that was that those options were declining in interest to our members, and the performance was not fantastic. They were expensive to run. And so they were not in sort of the fund or the members' best interest for us to keep them going. What we did instead is we have actually upgraded our focus on environmental, social and governance factors, so that's socially responsible factors, and we have a large team who are working on that, large by our standards, not large by some standards, but large by our standards, who are working on these factors, and we're applying it across every investment that we have in the portfolio. And we think that that is the most important way that we can make a difference, not only to the risk that is implicit in your assets, but also to the world. So from our perspective, the most important thing is, of course, members' best financial interest. But we do recognise that there aren't immediate financial issues that can impact on the value of your assets over the long term. And superannuation obviously is a long-term investment. So the socially responsible team looks at these non-financial risks, like, for example, how exposed is an asset to coal, how much emissions, carbon emissions, does a company actually put out? Because those sorts of things are immediate indicators that at some point in time there's going to be a risk to the value of those assets. And we work with the companies through our partners, ACSI, the Australian Council of Superannuation Investors, to reduce emissions, which is what's obviously required to get to net zero, as the world has committed to over time. So no, we're not going to be opening another socially responsible investment option at this point in time, but we are working very hard on socially responsible factors and making sure that we protect the value of your assets over the long term against shocks like these ones, and also that we make the world a better place for you to retire into.
That links into a really good question from Matt, directed to Mark. Are you invested in coal-fired power generation or coal mining?
When it comes to what we include and don't include, our general approach is actually not to exclude stocks from the portfolio in terms of saying we do not invest in this. The way we invest is we employ fund managers who have which we view what their approach to investment is, their ESG policies as being one part of that. But we will not put a blanket exclusion on them investing in that if there are opportunities there. We're in the process now in the last year or so, as Kate talked about with the team that works for me. We're very closely looking at the exposures we have. But what is critical is that for all the assets, whether it's one which does or doesn't have sort of a carbon exposure, it really is about what is the risk of that. We're investing on the basis of value, not values, and that's probably the way we look at it. And that is that we're looking at does that particular characteristic to do with high carbon, coal, whatever, does that provide a risk into the future for that asset? That's something that our fund managers assess and something that we also look at.
Okay. Kate, back to you on the binding beneficiaries status. John says, can you check your current one online? You can't fill one out yet. That'll come later in the year. But can you check your existing one online?
Yes, you can. You can just go into your member online account and there is a section in there that tells you about the status of your beneficiary nomination.
And Michael has a similar question, but saying, does using binding death nomination ensure payment to beneficiaries without the need for applying for probate?
Yeah, another interesting question. So it's important to recognise that the superannuation system and your superannuation assets are outside of your estate. It's a different set of legal arrangements. And so the payment of superannuation death benefit is a separate process from estate management and probate. So the one thing that controls how the trustee pays and how quickly the trustee can pay your estate or your superannuation account, your superannuation death benefit out to hopefully your preferred or your nominated beneficiary is actually whether or not you have a binding nomination in place. It's a separate process.
Okay. And Leonard's saying, is there an option that you can keep the funds within the super or pension account?
No, there is not an option. Once we are notified that a member has passed away, they do go into cash. Right. It is within the superannuation system, obviously, still, but what we do look to do is to pay that out as quickly as we possibly can, again, depending on whether or not there is a binding beneficiary in there.
Okay. John wants to know performance graphs. How long before we get them back, because they're a valuable tool before the mergers?
Yeah, thank you. They are back, actually. You just have to look at Member Online. You'll see them. You look at the website. They're definitely there. So we know that they were a valuable tool and, it did take us a moment or two to get them back up there. I know that, but they're there now. All
right. And John loves your line, Mark, that you invest in value, not values. So... and John Ian loves that line as well. So, yes, that has struck a chord with everyone watching at the moment. Matt, binding nominations. A lot of questions coming through on this, Kate. You've really sparked something here. Currently require witnesses. How will this work with an online system?
Actually, I'm not sure of that. The team are building it now, but I know that they're doing it. So just watch this space and it'll tell you once it's done. Have it. Yeah.
And Vicky wants to know, how much do I need in my super account to retire? I think we covered that a bit earlier generally. Just going through, because we've got a whole bunch of beneficiary ones that have come through.
Sorry, can I just say on that, we do actually run webinars specifically around nominations and nominating a beneficiary. I'm not sure when the next one is, but it's definitely worthwhile having a look on the website to find out when that is. If you're interested, we have found that it is one of those topics that people don't know much about, but when you realise how important it is, then if we can help you to do that as quickly as possible, we will certainly do that. And I'll talk to the team about scheduling one soon, because it's obviously something that's of interest to us.
Yeah, and it's so practical and so important. But as you say, everyone just forgets about it, don't they?
Absolutely.
Now, Laylit wants a view, Mark, on are you investing in Indian shares, which seem to be doing well?
We only have around 5% of our equity portfolio, that $17 billion $18 billion portfolio. We've got about 5% in emerging markets. China is a good part of that. India is not a large share of that. We don't tend to invest in specific countries, but it nevertheless, though, it is catching our attention. Increasingly, I'm finding I'll come in the morning and I'll find I've received emails from managers pushing sort of Indian shares, because the thing is, it is the fastest growing big economy in the world. It's growing twice the pace of China. And so it's an area where we're keeping an eye on, but at the moment, the investments are not that significant at this point.
Right. And Kate, a lot of people saying, yes, can we have that session on benefit and probate and all of that as well. Look, we've run out of time. Thank you so much to everyone. We got through a power of questions. If we didn't get to yours, the team are going to get back to you individually. So thank you to everyone for not only tuning into the webinar today, but the questions and the diversity of the questions were just so fantastic, weren't they? Now, we'd really appreciate your feedback as well, and a survey will pop up about 30 seconds after the webinar has concluded. If you want to be contacted, you'll also have the opportunity to leave your details on this online form as well. So we'd love your feedback to try and make these sessions even more informative. Before concluding, I wanted to remind you that Brighter Super is open to everyone. Brighter Super has a proud history of serving members in local government, energy and electrical sectors, and now the financial services sector. As an open fund, Brighter welcomes members from any other sectors and the wider community. If you're thinking, your adult kids want to be in a different super fund, or you have friends or relatives grumbling about their super fund, give Brighter Super a plug. Everyone's welcome. To learn how your spouse, your friends or broader family can join, go to brightersuper.com.au. We'd also appreciate it if you could leave a Google review or product review. Please simply scan the QR code on your screen. These reviews assist us with brand recognition and customer service, so we greatly appreciate your feedback on that. That draws to a close our webinar today. I hope you enjoyed today's presentations. Huge thanks to Kate and Mark for their contribution today. Took all questions beautifully, and that's the expertise that you have on call here at Brighter Super. A copy of today's webinar recording will be sent to you in the coming week as well. Thanks again for attending, and have a terrific afternoon.